Welcome to our COL Financial Premium Webinar Series. My name is Mark Orga, your Investor Development Officer, and I'm joined here with Mr. Edmund Martinez, our Wealth Management Expert.
Good evening, guys.
Hello. So again, we would like to thank you for joining us in our COL Premium Webinar Series. We started this initiative because we want you to partner with us as you build your journey in your financial aspirations and goals. I know that outside it might be traffic, you might be enjoying your dinner.
Right. You can see, I think we can see a bit of the traffic here in our office. And it could be quite terrible, I must say.
It is.
Right?
And that's why we wanted us to reach out to you by doing this webinar series.
It's easy and convenient. You don't need to visit our office to listen to us and enjoy our views. And
Definitely.
Tonight, we do hope that you enjoy whatever we prepared for you.
And in light of that, for this session, as your invitation indicated, we would be discussing about mutual funds and how investing in them could really make sense amid the economic conditions that we're experiencing right now,
right.
And of course to your individual and personal financial journey. So just a reminder for those who haven't seen the slides that were shown earlier on how you will be able to ask questions as we go along and right after the discussion. Let me show you how we will, or you will be able to ask questions via desktop. Let me just show you that.
Yeah.
So just type your desired question in the question pane. If you look at your desktop and just click send. That way we'll be able to read the questions right after or during the Q&A session.
Just in case you don't see the pane, look for that orange arrow where you can actually pop up that screen and find the questions pane and then ask us a question. So I think that's the reason why we chose a webinar format, so we can have that live interaction with our hundreds of attendees tonight.
With you, our audience. And for those who are listening in or viewing in through their mobile devices, be it iPhone or Android devices, you can ask a question just by clicking the question mark button or icon on the pane right there.
And it will come up and show you a similar pane to that of the website. So you can click it right over here, type the questions here, and then click the send button so you can ask us a question. And for those of you who are viewing through your mobile phones, you can log in through your, those viewing through their desktop can log in to their mobile by downloading the GoToWebinar app. And just opening our invitation email, you can click there and you can log on to our webinar.
Just click on that registration link.
All right. So
let's start.
Okay.
Why don't we start? Shall we?
Sure.
All right. So let's go back to that. I remember the invitation that we sent out to you, to you, our audience, and Ed, it says there, or it indicates where the high net worth individuals are investing their money. I see a 48% there.
Yes, that's kind of.
I'm quite intrigued with that 48%.
Right.
I wanna build my wealth and be a high net worth. How do I do that?
Me too, because I've been in the wealth industry for quite a number of years now, and I've never imagined funds to be that popular. So the question goes like this: know where the world's wealthiest invest 48% of their funds, and true enough, I'll show you a chart that is from that same survey from Capgemini and the 2016 Wealth Insights Survey. You see there, the highlighting yellow is the global allocation of high net worth individuals, which assigns 49% into mutual funds or exchange traded funds, right? So you can see just the power and the popularity of this segment, especially quite recently, when the fixed income assets or fixed income assets globally have reduced their yields, right?
And so, correct me if I'm wrong, but the way I see it is that a lot of these investors, let alone high net worth individuals, are having a shift or paradigm shift when it comes to investing into higher yielding securities or even instruments.
And for those people who don't really have that expertise to know where to invest, to time the market, or know what to buy the market, then the mutual funds is an effective way for you to get exposure without, the hassles of trading it yourself. Right? You can get a diversified exposure to these markets, and I think that's one of the things we're going to discuss in this webinar.
Definitely,
Right.
definitely. So stay tuned for that, ladies and gentlemen, as you enjoy your dinner again. But anyway, going back, so I see, yeah, right. You built a very compelling case when it comes to really shifting your funds or your investments into such instruments such as mutual funds. So does it mean that there's really growth into these types of instrument, and how do we participate into that growth?
That's right. I guess it's a fair question again. When I go to the gym or when I commute, when I walk around my town, and some people ask me, "You're from COL, right? So where do I invest? Or where can I put my money?" That's a very often question I get lately. But if I ask that to you, Mark, why do you invest?
Because I want my portfolio, I want my money to grow.
That's right, the growth. And I think that is the most essential question when you're trying to determine where to invest, is to find where the growth is.
Exactly.
And true enough, the next slide I'll show you.
You actually read my mind.
That's right. And the slide shows you that the Philippines has a new engine of growth. The chart to your left shows the composition of real gross domestic product. That's GDP. That's the national output of the Philippines. And you see there, in really noticeable figure, is the capital formation at 27.1% growth. And I tell you, I've been an economist all my life. It's the only time I've seen capital formation to be this strong, right?
Indeed.
And I think that's the new engine that we're talking about, because as before, we are often a consumer-driven economy. We never were an exporting economy. But in terms of consumption, we are number one. But oftentimes, we lack that capital formation, that growth in the in the GDP formula to sustain our economy. The right table will show you the composition of capital formation. So I've highlighted there the growth rates, as well as the percentage of GDP. And what really surprises me is the increase in the investments in factory equipment at 41%, which is now consisting of almost 15% of gross domestic product.
Wow. So I guess this is where the infrastructure play that we've been hearing about comes in.
No, not only that, but of course the infrastructure play will come into the construction picture. But here we're talking about factory equipment, right? Some equipment to produce more growth in the future.
Wow.
Infrastructure, of course, you know that to be the bridges, the roads that we use
construction
to reduce our transaction cost. But investments in factory equipment is supposed to generate more growth in the future. Imagine putting up a shoe factory or a factory for chips, right? It is supposed not only to employ the people working on to build that factory, but also to produce growth in the future.
Indeed.
Yes.
So just looking at the graphs and just looking how the growths are across each of the components, it seems that they're very, very robust, not to mention pretty much almost more than or almost 10%, if not twice 10%.
Right.
So I guess my question would be, next question is, isn't the Philippine economy and its growth overheating? Is that a concern?
Yes, that's a fair question, Mark. Let me show you the next slide that talks about inflation. There you go. So the graph to your left shows the headline and core inflation of the Philippines over the past 2 years. The blue line is headline inflation, and the orange line is the core inflation. You see that both lines over the past couple of months has stayed below 2%.
Indeed, yeah.
And 2% to 4% is the corridor that the BSP would like interest rates or inflation to be in, right? That means that, if inflation stays below 2%, there's a huge possibility for the government to still maintain that level of accommodation in the economy, meaning the money will still become very, very cheap. There's not any reason to increase the rates. But if you see the graph to your right, we break down the composition of inflation to its four most basic components. The first chart, you see FNAB, that stands for food and non-alcoholic beverages, right? You see that it already hiked 1.9%, probably because we didn't have such of a rainy season over we didn't have a good rain amounts in the last rainy season.
It's been quite hot, right?
Yes, quite hot. Even now that we're nearing December, it's still quite hot.
Yeah. Tell me about it.
You see there the HEGW, or the household electricity, gas, and water.
Utilities.
The utilities have gone really low. And FNAB is around 38%. You have electricity, gas, and water over at 19%. So that's trying to pull the inflation still lower, right?
Still offset.
So we're still very much dependent on oil prices. Again, it's driving the electricity, gas, and water, the power utilities. So as long as the oil prices remain relatively stable within that range, we cannot expect inflation to be
that much of a worry.
Yeah, that much of a worry.
So, in other words, we're still indeed in a very healthy economy.
That's right. And as mentioned a while ago, we're investing in the factors of production. Remember that an economy overheats when it produces beyond its capacity. And investments in capital formation increases that capacity. So that means it even increases our tolerance for inflation.
And that's for growth.
And growth as well.
Indeed.
Right? Yeah.
And now, I mean,
pretty solid,
wow,
yeah.
you've been building a strong case for the Philippine growth story.
Yeah.
So let's talk about fundamentals. How solid our fundamentals are when it comes to our actual growth.
Yes. In the next slide, I'll show you the three reasons why we think that there's solid fundamentals in the country. First, as I've mentioned, there is the new growth engine in investing,
which we just discussed.
Increase in capital formation. And of course, we have this picture. As you can see in the second slot, you see the demographic sweet spot.
Wait, right? let me ask, is this a line for a box office movie?
No, it's not.
No, it's not.
a line for a train, actually.
Okay. Not
for
Train
the
to
LRT.
Busan.
Train to Busan.
No, anyway, sorry for that
joke. It's a line for a train in LRT. You can just see. I mean, it's saddening, but the reality is it's good news. Believe it or not. Because we have a huge portion of our population in their most productive stage, right? But unfortunately, infrastructure can't keep up with it. And of course, we have an action-oriented government.
Let's talk about that. Let's talk about politics for a while.
Yes,
I know
right.
that sometimes
it's the big elephant in the room.
Yeah, you should. Adam Smith said that there's an invisible hand, so that the politics and the economy would work separately.
That's right. And I know a lot of people are quite concerned about the current administration. But to me, I'm not really a political guy. I just observe the numbers, and I think that he has said the right things in terms of his 10-point economic agenda.
10-point economic agenda, yeah.
And for the other things, I cannot comment officially, but in terms of the 10-point economic agenda, he seems to harp on the right things, meaning that you have a president that is building on the foundations built by the past administration. They're not supposed to change any of the good things that the past administration has done. There's, again, a renewed interest in pushing infrastructure and a strong commitment to reduce crime and corruption.
Indeed.
Which in most economic models, as you've mentioned, is treated as an external variable. But again, I guess it's time to plug our publication. We are also releasing next week our second issue of our Premium Suite, which will discuss everything about the relationship between crime and the economy. In fact,
and politics as a whole.
Yeah, politics as a whole. The crime is actually a tax that an economy pays for. So if you remove the tax, it paves the way for a higher economic growth.
Wow, very interesting. So for our clients listening in or watching us, stay tuned or stand by for that next issue. But going back, I mean, I'm very much intrigued with the second point that you brought up, the demographic sweet spot. Not because I want, or I have an affinity to that to the word sweet. No, not train, but sweet. But let's talk about that. How does the demographic sweet spot come into play when talking about the Philippine growth story?
The demographic sweet spot is a period in an economy where its population is most productive. It is also a point where the dependency ratios are very low, meaning that the part of the economy that doesn't work is relatively small compared to those who work.
Oh, okay.
For instance, imagine that...
So low dependency rate.
Yes, low dependency ratio or rate. Imagine a 10-person household, right? if 8 of the members are working, then only 2 are depending on the 8. That means if you have 8 people working there, they can, spend, they can,
Support
be
the
more
family,
productive and support the 2. But in cases of Japan or other economies, not only with the low birth rate, but with higher dependency ratios. Say, for instance, in that 10-person household, out of the 10 members, 6 are not working, 4 are. So imagine the burden on the 4, right? So the Philippines is in that sweet spot where the dependency ratios are low, and the median age is less than 24 years old. That means that half of the population is less than 24 years old, right before or right during their most productive age, right?
So, and I have a question for that. So, does this only apply to the Philippines?
Yeah, that's an easy assumption for us to make because we haven't really heard it from another economy. But in reality, it's something that happened in almost all the progressive countries that we have right now.
Oh, wow.
The next slide shows you about the golden demographic, the demographic window of opportunity as others have experienced it. So here you see a table, pardon the wordiness of this, but you can see here countries like China, Republic of Korea, Singapore, Hong Kong, the United States, Australia, Japan, France, Germany, UK, and Canada, all going through their demographic window of opportunity. Now, this table shows you the multiple of their real GDP, of their real GDP per capita, and private credit, and industry after the demographic era. So meaning that while a period, here is how their economy has expanded, right? So you see, example over here, that the Republic of Korea had their period from 1985, and in fact, it's not yet finished. It will end in 2020. Real GDP expanded by 5.51%. Real GDP per capita, meaning the GDP per person, has expanded 4 times.
Almost, yeah.
Private credit, access to home loans, credit cards, car loans expanded by 3 times. And industry, which I find to be an important element in any developing economy, expanded by 7%.
Wow.
Now, taking that into consideration, if you just average all the experiences of all these countries and you put that in the Philippine scenario, you can see amazing growth. This table shows you the GDP of the Philippines in billions of US dollars in 2015. And by 2050, when we're done with the golden demographic era,
when it reaches its potential growth, right?
Once you reach that potential growth, we can expect anywhere around $2 trillion worth of an economy. That's almost as large as what South Korea is now.
Indeed.
The GDP per capita, what we have right now is around $2,600 US, expanding to 13,000 US dollars. Private credit, which is now at 42%, can expand to 167% of GDP. And finally, again, my favorite slide here, industrial output in billions of US dollars at 89 billion US dollars. We see that expanding to 954 billion US dollars, almost 4 times the economy is now, right? So again, it's going to be a significant part of the economy. Why do I like this? Because industrial output has a higher output multiple, meaning if you put 1 unit of work in an industry, your multiple is around 10 or 12.
10 or 12.
Right.
So yeah, just looking at the estimated growth potential when it comes to our demographic sweet spot, they are very, very attractive, if not very compelling. However, my question is for the markets. We all talk about how the markets discount any future possibilities, right? And how it factors into their valuation. My question is, has the market already taken into account this kind of growth?
Again,
is the market getting too expensive right now?
I know you were going to ask that because you're a classic value investor, Mark. So if you take a look at our valuations, here the slide I'm showing you is that the gray line there is the average price to earnings ratio of the PSEI. You see in the past couple of weeks, we have seen the market really go above, I guess, 1 level above this average. So that means it's very expensive. You have PEs up to 22 to 23 times, but the recent market corrections have allowed it to return to its fair close to its fair value. It's not yet there, but it's not as expensive as before. But if our forecasts are correct, we can expect more movement of the market. We can expect, it's right to expect more corrections that will take the market closer to, I guess, fair or even cheap valuations.
So again, just to summarize what you just said, so it seems that there are still possible opportunities out there.
That's right.
To take advantage of any market dip or any market correction, considering that we just came from a high valuation of almost 22.5 or almost 23
That's correct.
PE, correct?
And if, as mentioned, if our forecasts are correct, we can expect the markets to continue this correcting fashion and have an opportunity to get more exposure.
Wow. Well, that's a very convincing. I'm now convinced that the Philippines is indeed a good area.
All right.
To partner with when it comes to growth.
That's right. So again, fundamentally solid market. We are expecting more corrections. We should see that the Philippine market should be. There's more reason for us to buy the market.
More reason to participate in, right?
Okay. So before I move on to our next set of slides, let us first show you a bit of our sponsors for tonight. We have, of course, COL Fund Source, the first fund supermarket in the Philippines.
That is a one-stop shop for our mutual funds.
That's correct.
We offer to our valued clients out there. So perhaps most, or some, if not most of you who are listening in, our COL Premium clients might have already purchased some mutual funds through our COL Fund Source.
That's correct. The Fund Source, of course, is the first fund supermarket. We have 90% of the funds in terms of AUM, so we have the big boys there. And the best thing about Fund Source is, first, we have transparency over data. You can see performance, fees, even Sharpe ratios if you're into that. And most importantly, you can buy a favorite fund with zero front-end load or no commission.
So in other words, we help you out there.
Yeah, right. So now, talking about mutual funds, Mark, can you talk more about mutual funds?
Well, that's actually
what are mutual funds?
That's actually a good segue. Just showing the COL Fund Source. Well, mutual funds, for those, again, who have come across such investments, who also own such, these are just pooled investments that are invested in different investment or asset classes, which are professionally managed by an expert fund manager.
Expert fund manager. Can you talk to us more about what professional management is?
Sure. So actually, that's one of the benefits that I'm going to go through as I continue the concept of mutual funds. So professional management just means that the funds are pretty much studied or well studied by these experts. These experts are seasoned, well trained when it comes to their strategy in picking the right investments for the fund and for the investors themselves.
So you've worked in one of our fund providers, right?
Indeed.
What is it like? Do you see the fund manager there? Does he have what?
Yes.
3 people, 5 people?
One misnomer, one misconception about a fund. When we say fund manager, we automatically, or some clients or some investors would think that the fund manager is just a single person. But contrary to that belief, fund managers are teams of experts which really are dedicated to their craft. So, for example, you mentioned that I worked for an asset management company a few years back. I'm not going to say how long, but I've met some of these fund managers, and they do have a team that researches on a particular investment, like what I just mentioned. So they have a dedicated equity researcher for their equity funds, a dedicated fixed income researcher for their fixed income funds, and not to mention, more often than not, they also have their own economic team that also complements their fund strategy or their fund investing objectives.
Imagine, who could beat that?
Indeed.
Right. So what about the next point there, diversification?
Yeah, let me talk to you about diversification. So when you try to invest directly on stocks, you have that concentration risk, right?
Right.
That if you invest in a certain company, if knock on wood, it goes bankrupt, of course, knock on wood, or doesn't perform well, then your stock investment would go down. Diversification is just like what the old adage says, putting your eggs not just in one basket.
So not putting your eggs in one basket.
Not putting your eggs
That
in one
means,
basket.
for instance, an equity fund, how many assets are there usually in an equity fund?
So, I mean, from my experience looking at different equity funds, I guess it's safe to say that there would be 12, 15 to 20
Right.
different stock investments in an
Right.
equity fund. So imagine the risk is pretty much spread across those 15 companies.
Right. So, for instance, in those 15 companies, in case one company goes bust, again, knock on wood,
Knock on wood.
it doesn't affect the entire
It
portfolio.
doesn't affect your own
That's right.
the portfolio. But again, it goes back to that professionally managed benefit wherein these fund managers will do their best
Right.
to invest in a company that won't really do that that bad.
Or declare bankruptcy.
Oh, exactly. Yeah, yeah.
Right,
So
right.
they do have their own regulatory research there.
Right. Okay.
But yeah, diversification, like most investors, if not all, would agree. Aside from getting a higher yield for their investments, it's all about risk management.
That's right.
And what better way to manage your risk than to diversify?
Correct.
Correct?
How about liquidity, Mark?
Yeah, liquidity.
Liquid, right?
Let's talk about liquidity.
How is it different from the liquidity I get from my equity investments?
Cool. All right. So again, going back to equity, direct stock investing. When you just like think about of buying something in the market.
Right.
Right. When you buy or sell a stock
Right.
to the Philippine Stock Exchange, you make sure, or the broker makes sure,
That you
that
have a counterpart.
you have a counterpart in any
Ah.
transaction. So that means that they have to look for a seller if you're a buyer, and vice versa, a buyer if you're selling.
Right.
But for mutual funds, all you have to do is instruct the mutual fund company that you're going to redeem or buy shares, and they will immediately do their best to redeem or buy shares within the settlement period. SEC regulates that it should be less than or within 7 days, but here at COL, we do our best to, depending on the mutual fund, to give you the proceeds within 5 days.
So that means you don't need to have an actual buyer when you're trying to sell, right?
Yes.
So the mutual fund company will buy the share from you.
Indeed.
Right?
But just to take note, for our clients, if not all of the funds have a corresponding holding period. When they buy it on their initial purchase,
right.
there's a corresponding holding period. But that doesn't really take the liquidation or liquidity benefit from mutual funds.
Right. And now for our last point, what about affordability, Mark?
Affordability. So this is quite, as I personally, I would say a tricky word. Affordability. Of course, affordability means cheap, right?
Right.
But more than the cheap aspect, we don't want to say that mutual funds are cheap,
Right.
but rather value for money.
Right.
So as low as our minimum investment for some funds, as low as 5,000 pesos,
Correct.
you can start investing in mutual funds.
All
and
right.
that 5,000 will have a diversified access to different investment asset classes.
Right. So with all these benefits, you have a professional fund manager, you're diversified, it's liquid,
It is.
dividends in some funds, in some US dollar funds. You can even give you access to markets, then the 5,000 is a small amount.
Yes.
So you try to imagine investing in 30 different stocks, or how many did you say that a mutual fund is invested in? 15, right?
15 to 20.
Imagine trying to invest 15 companies with 5,000 pesos.
Exactly. I mean, just
Might
for
be difficult
example,
for everyone to do that.
one of the leading telecommunication companies that are listed in the PSE,
Right. PLDT,
for instance, Tel, you buy that for 5,000, you'll just have, perhaps you'll be lucky to have.
I don't think you can buy it.
I know.
Because the minimum lot is 10 shares.
10 shares, and you
around
can.
1,700.
I know.
So that's 17,000 pesos just for PLDT. But for a mutual fund, you can buy a fund which has PLDT in it and 15 different companies all in one fund.
Indeed.
Right? Okay.
So every benefit complements each other.
All right. So Mark, and if I'm not mistaken, when I ran yesterday,
You did.
and
Was it raining yesterday?
Yeah, I mean, sometimes I run into
Okay.
Just trying to keep fit. But a lot of people ask me about their framework of investing because, as you know, the customers who are listening to us in their homes, that each and every broker, wealth management institution, or bank has their own investing philosophy, right?
True.
And it seems to me, in my experience, that it's not kind of aligned, right? For instance, in some of the banks, they ask you to answer a risk profiling sheet,
Suitability assessment.
a suitability assessment that they consider to be the holy grail of the entire relationship. That if your risk profile falls beyond a certain degree, they don't sell you a fund. They ask you to all sign all sorts of disclosures and whatnot. But I still have yet to find a framework that will, cover all their portfolios. Of course, until now. We have a very unique framework we'd like to share with you. So let's talk about your 3 portfolios. In fact, each and every person in the economy, or each and every person living, breathing, has 3 portfolios that he has to worry about, right? You have the safety portfolio, you have retirement portfolio, and your aspirational portfolio. Each of these portfolios have a different risk tolerance, has a different objective, and hence different ways to invest, right?
Yes.
So like for instance.
Yeah, I'm quite curious. Let's talk about that safety first. I see a hard hat.
Right.
Does that mean that these are the emergency funds just in case along your financial journey you experience some
turmoil, right? Or some volatility?
That's a very strong
job. You're absolutely correct.
Uncertainties.
Yes,
Uncertainties.
Absolutely correct, Mark. And in our careers, of course, we experience some volatility, and that safety portfolio is supposed to answer for that, right? If you're employed, of course, the recommended emergency funds are 3 months. If you're self-employed, you're an entrepreneur, the recommended safety portfolio or the recommended emergency fund goes as much as 6 months, depending on your comfortability. But again, this portfolio is supposed to insulate yourself from the risks. Now, this portfolio has a very, very low risk tolerance, meaning you cannot risk this portfolio.
So,
right?
Obviously,
imagine if you've invested 90% in equities and you suddenly lose your job. You can't go to the store and buy them with stocks, right? It's crazy, right?
Not to mention the fluctuations that you're going to
That's right. And the safety portfolio
investments
should be liquid, should be safe, has to be with you. And on to the next portfolio, of course, your retirement. A lot of people forget to prepare about retirement, and it's something that we have to prepare for.
And we think about almost.
I think
even if you forget, I mean, it's quite ironic because you mentioned about us forgetting about retirement. But sometimes we think about this during the wrong times, as I would say, because for me personally, when I started my job or started fresh from graduation, I started thinking about this. But some people do think about this. But some people do think about this when they're about to retire.
That's oh my God. I mean, I've had a guru before, and he was telling this adage that there's really no suitable time to think about retirement, because when you think about it, it's almost always too late.
Yes.
And the best time to start is when you start working. And just to talk to you more about this portfolio, it's something that we all need in our lives, but because of the risk, because of the tenor of this portfolio, then you can take market risk. Now the question is, if I'm a risk profile 1 or a conservative investor, will I still take an equity investment for my retirement? And the short answer to that is absolutely.
Sure.
Meaning you may have a low risk profile now, but you have 30, 20, 25 years to save.
So it's all about knowing what time frame.
And when you have tenor in time on your side, then volatility gets ironed out. So as mentioned here, the risk required is around medium, and the products recommended are the equity index funds, some equity funds if they're conservative, and bond funds for risk management. Again, while your time horizon is low, it cannot take too much risk also. You know what I mean.
I know. I know. Well, let's talk about it and move on.
That's right. And that portfolio is for aspirational portfolio.
I see a Learjet there.
Does
that mean that aspirational portfolios are for, let's say, for a lack of better term, those luxuries that we want in life?
That's correct. Because, as Warren Buffett would tell us, you don't get rich by getting market return. In fact, he countered that, meaning that he was able to build that wealth by taking risks.
Mm-hmm.
And that's what we want to teach our investors here, that while you have those three portfolios, always allocate a portion of it to take that risk,
Sure.
meaning either through an actively managed fund or through direct stock investing where you can get the returns but also experience that risk, or another business or a
Mhm.
business investment. But again, these portfolios shouldn't mix. You can't use your safety portfolio to invest in for aspirational goals, or your retirement portfolio for aspirational goals. Has to be different because these portfolios have different requirements and different tolerance for risk. Right?
And that explains the products that could be included in such portfolio.
That's correct.
Which are very volatile, as I would say.
Yes, and if you talk about the Forbes 500, they often publish this list of wealthy people, meaning the top, the wealthiest of the wealthy, and you would see in their lives that they didn't really invest in the market, meaning invest in an equity index fund. I mean, it's supposed to get you through retirement, but not build their aspirational portfolio.
Definitely.
So have those three portfolios, guys. Safety, right? Retirement and aspirational portfolios.
We encourage you, to our clients out there, to consider these three portfolios as you walk and journey to your financial journeys along the way. Okay.
All right. So moving on. Of course, we're not gonna keep you guys bitten with all of this. So here are the fund recommendations for these portfolios. Of course,
we're not gonna
qualification there.
We're gonna send this, just a reminder. We're gonna send the deck as we finish this webinar, perhaps Monday next week, to our viewers. But this slide just goes to show how our funds complement those three portfolios that you mentioned.
That's absolutely correct. Again, just to add on the aspirational portfolio where you see the Learjet, you can also try to directly invest in stocks. So in COL Financial, I think we make the best traders, meaning we equip the best people to properly invest in the market. So again, we will be holding other webinars for you, our valued customers, and the tens and hundreds of people who are attending tonight. Stay tuned for that. Watch out for the invitation if you're interested to attend those seminars or those webinars. We'll be happy to send you an invitation.
All right. So wow. Well, we already have the Philippine growth story and how we're going to participate in such individual funds, considering those three portfolios. Perhaps the next, not question, but thoughts in our minds is, how are we going to make sure that we are going to walk seamlessly and reach our investment goals and objectives?
And we do that by giving you guys some investment tips
and guidelines.
Okay, Mark, let's talk about the first slide.
Oh, okay. So inflation, be wary of it. Remember we discussed about that earlier during your discussion about the Philippine economy.
That's right.
And how prices go up. This graph just goes to show how not investing in higher yielding instruments or assets could take away the value of your money.
That's right. If you see here, the blue line shows you all of these start in 2004, where a person has 1 million pesos. The blue line shows you the path of his investments when the person does not invest. So at the end of the line in 2014, that value is now at 600,000. The amount of goods and services his 1 million can buy today is only at 600,000 pesos. And that's because of
considering inflation.
Right.
Because a lot of just looking at the graph, initial impression would be my 1 million will still be 1 million after perhaps 10 years, but not really because of inflation, right?
That's right, correct.
So just perhaps another example would be just going to the grocery 10 years ago. With 1,000 pesos, you would have bought
already probably
a stroller
worth
of goods and products. But after 10 years,
perhaps a basket. Laundry na lang yun.
Laundry na lang. Full time.
All right.
Yes. Anyway,
another important message of the slide is how equities can help you beat inflation. So here, the gray line shows you that after 10 years of investing, your 1 million will be more than double.
More than double, actually.
But you have to be wary that volatility is inherent in equity markets. You see, in 2008,
which is the global financial
crisis, the equity value actually dipped below the bond value.
Actually, close to inflation.
Close to
right.
inflation,
Yeah.
actually. Oh, right. All right. So again, beware of inflation and always realize that equities is the most effective way to fight inflation. So never keep it out of your portfolio.
Should
In
you
terms
stay
of
invested?
yes, in terms of volatility, I know it's something that we should worry about, but later on we'll share a tip.
A
Right?
tip regarding that.
Okay, so the
Moving
next
on to another
tip
guideline.
is
Let's talk about timing the market, Ed.
correct.
We all talk about how timing is really important to maximize our gains. Is that true?
That's right. Timing may maximize your gains, but I like to highlight to everyone that without the proper training, timing could be difficult. Okay, the slide shows you the returns of the Philippine Stock Exchange Index from January 2003 to November 2015. And of course, the return will be at 17%.
17%.
Pretty amazing, right? But if you miss the 50 best days of the markets, okay,
50.
from January 2003 to November 2015, that's only 1.61 days, 1.61% of the days. The return would
almost
be
less than 2 months worth.
that's correct, and that's low as that is your return will be as low as 1%, and that is no different from the 1% of a 35-day time deposit when this slide was made back in November.
So,
So pretty compelling. You have to be
compelling.
really good to be in the market in that 1.61% of the days where it got its best time.
So I guess this complements that saying that it's not really timing the market, but time in the market.
Yeah, better just be in the market, right? You
Stay
get
invested.
17%. Stay invested. But if you want timing, of course, COL Financial is one of the institutions wherein you can learn how to time the market. We have seminars here, and we also we have nothing in schedule right now, but we have a show coming up in November, which which will talk more about timing the market,
Timing
or
strategies.
how to do it properly. But of course, if you don't have time, you don't have the skill to do this, then the mutual funds could be a good venue for you to have that time in the market.
Indeed.
Right. So Mark, let's talk about compounding.
So time in the market is also complemented by the power of compounding.
Correct.
So compounding is basically reinvesting the returns that you would get
Yes.
if you should you stay invested. So we did the simulation for 3 investors
Right.
who really tried to take advantage of compounding, except for one. I'll show you why. So this is an assumed 14% annual average return of the Philippine stock market to the PSEI, the basket or 30 stock basket of the Philippine Stock Exchange. So let's focus first on the first investor who started his investment with 50,000
Per annum.
per annum, contributed
30 years ago.
50,000 per annum for a continuous period of 30 years.
Yeah.
So that 50,000 grew to a whopping 22.8 million.
Wow.
That is just by contributing and at the same time letting the gains be reinvested.
Right. So you allow your gains to earn more gains for you.
Exactly.
Right? In
The
that
power
position.
of compounding.
Oh, right.
As Albert Einstein would say, that compounding is the 8th wonder of the world.
Eighth wonder of the world, huh?
Yeah,
I think that's
misquoted.
though.
I think so, yeah. But moving on,
Anyways.
investor 2 who realized that, well, compounding does really work, so might as well start it. But this investor started 16 years after, so almost half the period of the first one. His grew to 3.3. Compare that to an investor who didn't compound, meaning
Right.
he took away any
His
gains,
returns.
his returns. His 50,000 on a yearly basis just added up to 1.5 for a period of 30 years, mind you.
Right. Wow. That's terrible. So if you just invest for 30 years, you don't compound, then your money will be at 1.5 million. But if you compound,
Imagine that.
that's 22 million pesos.
Just disregard the
Wow.
figures. Just look at the
Right.
graph on how the
Yeah.
difference is.
Right. And I think the mutual funds offer automatic compounding. That's I
They
think
do.
one of the few things we failed to mention in the advantages.
They do.
But when you, for instance, invest in a fund, the earnings of the equities or the bond components gets reinvested and compounded for your benefit.
So for equities, that will be the dividend
So
payments.
you don't have to really check your bank account and reinvest it, but instead the fund manager will do that
Fund
for
manager.
you. Kaagad.
Exactly. Yun yung professionally managed.
Right.
Okay?
And talking about portfolios, I'd like to also show you a slide of a study done in the United States. Here's the study by Ibbotson and the gang, by Brinson, Singer, and B. Bauer as well. So they were talking about the determinants of portfolio return. They studied the top 70 pension funds in the United States, and they tried to determine which dictated the return of the portfolio. So as you can see in the chart, 91.5% was determined by asset allocation alone. Stock selection contributed to 4.6%. Market timing contributed only 1.8%, and second-order effects, or the second derivative effects. Yeah.
Let me stop you.
Right.
Let me stop at that. So that means that just by having your asset or investments just allocated,
right,
and just let it sit, the returns, or 91% of the returns, are coming from that thought?
That's right. And of course, a lot of wealth managers kind of wrongly define this. They think that asset allocation is just diversification with the fancy name. But asset allocation is just determining the mix between equities, fixed income, and cash, depending on your risk profile. So that alone, determining that policy that you determine when you join a fund, determines 91.5% of return variability. So that alone is enough. Again, a mutual fund offers asset allocation, especially if you are invested in a balanced fund.
Balanced fund, indeed.
Okay.
All right.
All right. So next slide.
Of course, as we've always been saying during this discussion, during this webinar, expect volatilities along the way. We've been showing graphs of equity funds, and not just equity funds, but bond funds. But you see how the movements of the returns really do swing from time to time.
Right.
And especially for our case here in the Philippines, this is a graph of the PSEI from 1987 to the present.
Right.
And from that time on, we've seen a lot of dips and volatilities that happened because of events such as the 1990 coup attempts, the Asian financial crisis, especially the 2008 global financial crisis, where you see a very, very deep correction we experienced. Just this year, we also experienced such when most Asian markets did a sell-off during the start of the year.
Right, correct.
So, we're not saying that it's going to be a sale or it's going to be a smooth ride, but expect volatilities along the way.
It's definitely not going to be a smooth ride, meaning that it's inherent in the equity markets to have such volatilities. And in fact, I was again running the other day.
You were?
Not.
You really like to run?
I like to run.
You, huh?
And I think I need to run, but they were asking me.
Out of necessity.
Out of necessity. From the 8,000 level to around 7,600, 7,700, where the market was before, I already get a lot of questions. What's happening in the market? It's going to be a deep correction. What's happening? Is it the end of the world? I mean, I tell them no.
Delubio.
Delubio. If we've had more, it's not our first rodeo. We've had deeper corrections before, as Mark mentioned. As you've mentioned, see here in the graph. The Asian financial crisis, easily 48%. The global financial crisis, more than 50% correction. The European crisis, around 20% correction. So again, it's inherent in equity markets. But as our founder would often advise us, that this is inherent in the market, and as long as your economy is growing, as long as there is growth, and as we've shown a while ago, there is growth, then you shouldn't worry about the corrections.
Matter of fact, I'm looking at the corrections and the deep downturns on the graph, and should you just stayed invested,
right,
and took advantage by adding more funds,
right, correct,
then you would have really not just recovered, but really have grown your portfolio.
In a market this volatile, I think you can even do a sort of an easy investment program.
Exactly, that's our strat or program that we offer our investors to peso cost average and take advantage of this dips.
Yeah, I mean, if you don't have the time to really watch over your portfolio, just do an EIP, then that's it. Right? Try to buy or spread out your risk across time and have an opportunity to buy the market at a low price.
Yeah, indeed.
Okay. Again, talking about volatilities, we may be concerned about it, but our advice to our investors is to stay invested and take advantage. Here you can see the returns of the PSEI through a 20-year period. You see that 65% of the years will be positive. Right? So in the sense, it's 1 in 65. 100 over 65 chances that you will have a positive return.
Wow.
But if you hold your equity investments for 5 years straight without withdrawing,
any point of time,
any given point during that 20-year period, the odds increase by 70%. Yeah. Hold it for a longer period, say for 10 years, then the percentage of positive returns in any of that 20-year period in rolling terms, meaning you're holding it for 10 years, the percentage of positive returns should be at 95%. So imagine that.
So indeed, time is your friend.
So time is your friend. When you have a friend who's worried about volatility, then just tell him. I tell you guys, just stay invested and take advantage. We have a growing economy, and you can do that also through mutual funds. Right?
Wow. So as we wrap up this, thank you for joining us. But as we wrap up our webinar session tonight, we'll just give you some key takeaways that you can bring with you.
Okay,
as you drive through traffic
or enjoy your dinner.
Yeah,
I think we've been talking for quite an hour.
I know.
Now. Okay, so for key takeaways, as markets continue to correct, we may have an opportunity to buy the market at more attractive valuations. Again, the corrective motion may not be over yet, but again, no one can tell what the future holds for us. So as the corrections continue to happen, valuations will become more attractive, and it's a chance for us to buy into this market.
And talking about opportunity, again, this is an opportunity for investors to gradually increase their exposure to a fundamentally solid market, considering that we're still starting the demographic sweet spot.
That's correct. And if you're worried about those corrections, just go back to basics and ask yourself, why am I investing? And the growth is the reason. And the growth story of the Philippines is still intact despite political noise. It's just political noise.
Sure. But
okay.
Again, mutual funds offer strategic investors a diversified way to getting their exposure. So it's all about really spreading your risk, but at the same time, getting there as far as getting that yield is concerned.
Correct. So mentioning about mutual funds, you can use them to build your three portfolios. Remember, try to make your safety portfolio first. You have your retirement portfolio, and finally your aspirational portfolio if you wish to, have a pleasant financial journey. Okay?
So there you go. So now we're going to move on to thanking you for
thank you very much,
joining
everyone.
us.
Yes, but before we end, I think we have time to answer a few questions.
A few questions from our audience. Let's see. Again, as a reminder, while we try to see whether there are some questions here, you can still ask questions through desktop just by typing the desired question in the question pane panel and just click send. Okay. For those,
I think we have a question that's live right now.
And let us just check.
Ayan, we have a question.
We have some questions here.
What is the lowest support for the PSEI that we are looking at? According to our technical analysts here, Mr. Juanes Barredo, we're looking at a possible strong support at 7,300 level. So I think that's also the 50% retracement. So better watch for some good support over that level. So me too, I've been trying to get in the market, but I'm still waiting for these support levels to happen.
Yes.
But again, I think this audience who asked that question is a trader, right? So not too. It's also good to try to consider some of the mutual funds in trying to get into the market. If you're not concerned, if you're quite concerned about timing and or if you can't adequately time the market, then the mutual funds can give you that exposure. Okay?
Okay, so let's see some more questions here.
Yeah. Another question here from another audience member of ours. Again, thank you very much for attending. What is a better investment? Is it a direct stock or a mutual fund?
Well, depends. Here at COL Premium, we make sure that our clients really know themselves well when it comes to evaluating their financial needs. Let's say for instance, if you're really well versed and experienced into trading, or if not really looking at the companies fundamentally, you have your own time to research, then direct stocks could really bode well for you.
Mm-hmm.
However, like what we've been saying this past few minutes, that is, mutual funds are for those who might want to just sit back and relax, so to speak, and have their funds being managed by an expert. That doesn't mean that they wouldn't know where the funds are invested.
Right.
Matter of fact, we provide research tools to really help them know where their monies are invested.
Right. All right. Okay. Thanks. We'd like to answer more questions from the board. I think we have quite a couple still, but in the interest of time, we would like to apologize. We've been having this for quite some time now, so
we're gonna make sure that this won't go longer than an hour.
Right, but we have already
said that the session would be 7 to 8. But
right.
rest assured, like what we mentioned, we're gonna send out the deck to the emails,
and we'll try to answer some of the questions that we have. There's actually quite a lot. So for those of you who are asking these questions, I'm afraid we have to answer them offline
through email.
I try to send you those responses, and I guess that's it for us.
That's it for us tonight.
Okay.
Thank you for joining us for almost an hour of a very insightful discussion
thank you very much.
How mutual funds can help you build your wealth along your journey.
Through us
here at COL Premium.
Yes.
All right.
And
so, Ed?
I'm Edmund Martinez.
And this is Mark Orga, your Investor Development Officer. Again, we will be having a series of these kinds of webinars to give you more tools for your investment journey.
And as we say here in COL Premium, the journey to a richer life is easier with a little help.
Good
Thank you
night.
very much.
Take care.
Take care.